They told us inflation was dead, yet the Fed's favorite metric is still climbing. Retail investors are buying while institutions sell. Wonder who's going to win that one. Hyundai is pouring billions into U.S. factories, but will tariffs drive up costs? AMD lagging behind Nvidia again, but is AI demand really falling? Stick with us because in the end, we'll tell you what's really driving markets, should you reinvest dividends or cash out, and how to play it smart. Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Rob Ferry, and he's the CEO and founder of Flying V, our digital marketing partner. Rob, how was your week today? Or your week? How was your week today?
Week today's good. Just getting started, right? We're rolling into April tomorrow as of this recording. April Fool's Day, so always got to be a little bit alert, for any shysters and whatnot. But the last week was great, and we've got a ton to talk about today, Gary. Lots happening in the markets. Just wanted to get, actually, before we jump in, just everything going on, right? I mean, what's your general sentiment, macro environment? So much movement with tariffs, President Trump in office, seeing some of that stuff roll out. What's your general message to investors that are out there with what you're seeing in the market?
So, Rob, one thing I think is really interesting is a lot of people are understandably talking about what to them appears to be chaos from the Trump administration regarding tariffs. And in fairness, President Trump is being vague, or where he says definitive things, they often change a day or a week later. He's announced tariffs and then pulled them back. He's announced tariffs, delayed them. He's, talked about reciprocal tariffs, which I actually think may end up lowering tariffs across the board, something that the anti-tariff crowd is not talking about or doesn't understand. And a lot of people are saying, why is he doing this? He's creating chaos. The stock market hates uncertainty. It's one of the many reasons the stock market has been down in recent weeks. And the thing that I would say is, I don't think that this is an accident. I don't think it's chaos. I actually think it's a plan. It's one thing that I've written about at length under the category or the title of "They'll kill stocks to save bonds." I actually believe it was Michael Guyot who coined that term, although I'm not completely certain. But the fact is, because Janet Yellen reduced the duration on the Treasury portfolio for the United States, new Treasury Secretary Bessent has to refinance $7 trillion in the next 12 months. That is an enormous number. And as a result, what the Trump administration is trying to do is they're trying to take down the stock market, push money from perceived risky stocks into the seemingly safe haven of bonds, which, I don't agree that bonds right now are a safe haven, but that's what the market thinks. In doing so, they'd raise bond prices, lower yields on treasuries, and enable the new Treasury Secretary to do a massive refinancing at lower rates. It's why last week somebody asked President Trump about the decline in the stock market, and he said he had no idea. He said it'll take care of itself. And he's right about that. The president of the United States does not have control over the stock market, but this is a huge change from a president who, in his first term, regularly used the stock market as a report card. This time around, he's basically saying, I don't care what equity returns are. We just need to refinance.
Interesting, and thanks for just giving us that high level analysis. No, it's been a rocky few weeks in the market, and but hang in there, don't panic. We've got you covered with all the information that you need on this week's version of the 5 things. We're calling it the non-transitory inflation issue. If you've been following along with Deep Knowledge Investing, you've heard those words before. We're talking about the PCE, the report coming out there. We've got retail investor information, what we're seeing from the retail markets. A OEM makes an appearance here in terms of investment into U.S. infrastructure, AMD, Nvidia, and then, as always, we'll wrap things up with our educational thing to help you further your knowledge and education in the stock market and all sorts of investment topics. Gary, jumping into thing number 1, we're talking about the core PCE. Paul Krugman said that we've defeated inflation. Well, he said this in 2023. Thing number 1, Gary, PCE is rising again. What do we need to know?
Yeah, so Krugman calls himself an economist. I would relabel that as a partisan narrative spinner. But he a couple of years ago said we had won the war against inflation and at very little cost. Yet here we are. That was always a lie. So this past week we got the Personal Consumption Expenditures Report (PCE). The PCE is the favorite inflation metric of the Federal Reserve, and the reason for that is because it more closely matches consumer experience. As a reminder, when we get the CPI, the Consumer Price Index, that's a basket of goods. And your experience will, of course, be different. Over the last few years, people who had to buy a new house or, rent something that, at a different rate or buy a car, they experience much higher inflation than, people who were buying hard goods where prices were much weaker. So it really depends on your experience. And that's why the Fed looks at the PCE, because that's what consumers are actually buying, what they're actually spending. It's their experience. So the February PCE was up 2.5%. That was consistent with last month and consistent with expectations, but there's been no significant improvement in the PCE over the past year. We have a chart in the written version of the five things, and you can see that is pretty flat for the last year. But the core PCE, and the core number excludes food and energy. That was another story. That metric was up 2.8%, which was both above last month's 2.6 and above expectations of 2.7. The monthly increase in the core was 0.4%, which sounds like not such a bad number, except that 0.4% month over month annualizes to 4.9%. That's a problem. Like the all items PCE, there's been very little progress made in the past year. And so what you see when you look at the chart, which we have in the written version, is that the PCE inflation goes up, peaks in 22, and then we have disinflation, which is just a slower rate of inflation. And then about a year and a half ago, that chart gets pretty flat for both the core and the regular. So we have not defeated inflation, and it is sticky and definitely not non-transitory. As a reminder, we started warning people about higher non-transitory inflation in November of 21. That's almost 4 years ago. So, Krugman was wrong, and anyone who used the word transitory was wrong.
Yeah, interesting. And Gary, you mentioned the written version. Just so everybody knows, if you head to our website, you want to add your email to our newsletter list. Every week, we deliver a written version of the five things as well, jam packed with all sorts of charts and great information and takeaways from Gary that he's given on this show here, the Five Things Show. Gary, with that, what are we seeing from consumers when it comes to their income, savings rate? Is there anything that we could see that the consumers are telling us, or what are you seeing from them?
So there was a really big number in there regarding the personal savings rate. So we do get that every month with the PCE report. And that's risen in each of the past 2 months while Americans' expectations for the economy continue to fall. Um, so income was up a strong 0.8%, and that means people are spending more, but also saving more, which seems like a rational response to me. So if you want to take the negative side of that, you would say, we have a consumer led economy. Consumers are not spending. That's going to be a problem. And yeah, when, Americans stop spending, the economy, if you have a consumer led economy, if we have a consumption based economy, less consumption, becomes a problem. But I actually don't mind seeing this. I have been concerned about the fact that Americans have been using more credit, about all these reports that, the vast majority of Americans don't have a few $100s saved up for any kind of emergency. When people are expecting a weaker economy going forward and their response is to save more, I actually view that as a good thing. These are people who are, saving for a rainy day. I'd like to see that. I don't think it's a bad thing. The potential difficulty to all this comes if Doge succeeds in cutting wasteful spending and employment. If they succeed in doing that, we would see reduced government spending, which would make more clear the weakness in the productive private sector combined with continued inflation. That's going to create a dilemma for the Federal Reserve. The only thing that I would add to that is if cutting wasteful spending from the government creates some sort of economic problem, then that means you had a problem to begin with, right? If you need government waste to make your economy work, you don't have a working economy. And all that's happening right now is the weakness in the productive part of the economy is becoming more clear. So we're not really having an economic downturn, despite what the statistics will say. What we have is more clarity on the current state of the economy. This is something we've been talking about for a couple of years now.
Yeah, I believe it was hiring people to dig holes and then hiring people to fill them back up.
Yeah, it's an old expression, but it fits our current situation.
Gary, moving on to thing number two, we're going to talk about the retail investor market. We're seeing retail investors putting more and more money into the stock market, even when you're starting to see institutions actually reduce their exposure in the current market. Thing number two, Gary, we're calling it confidence overreaction. Retail investors stay bullish. Thing number two.
All right. So, Rob, at the end of last year, retail investors poured $71 billion into the market. That's a really big number. This year, in the first quarter, it looks like that number will be in the neighborhood of $67 billion. Only with the market down, they're getting better prices. That $67 billion has gone into US equities and ETFs. Tesla and Nvidia alone, $5.1 billion in retail buying. So retail investors are consciously betting that the risks that we were just talking about won't derail the market entirely, and that momentary losses aren't seeming to steer them away. Um, and all of this is happening as institutions are exiting the stock market.
Yeah, I mean the chart, Gary, in the written five things. I think it's just a little over 60,000, or excuse me, $60 billion in quarter one of 2025. All of 2024, we only saw about 150 billion from this same category. So, retail investors putting more money in the market. What other thoughts on this? And is data relative to the PCE that we also just discussed in thing number one?
So, a couple of things, Rob. One is that professional investors, the institutions and hedge funds, mutual fund managers, they are getting out of the market because they're worried about the uncertainty related to tariff decisions, which are supposedly coming later this week. But who knows? These things have been changed so many times; they may change again. I think retail investors have been trained by years of experience to buy the dip. And, right or wrong, that's what they're doing right now. And so, I have 2 points I'd make on this. One, I think it's really interesting that as, professional and institutional money managers are unloading, it's retail stepping in to buy. This is a shift of risk from institutions, from basically Wall Street to Main Street. We'll see who's going to win that one. Um, and then I also think it's really interesting. We were just talking in the prior segment about the savings rate rising while retail investment in the stock market is rising as well. So to me, it looks like Americans are saving more and investing more and consuming just slightly more, but it looks like more money is going into savings and investment than additional spending, which I like to see that. I think that's a great strategy.
Yeah.
If you are watching this, to the extent that you are able, it's great if you can spend less than you make and save and invest the rest. Just a reminder, you cannot save in dollars. They will be continually debased. So the purchasing power of the dollars you save today will not buy you as much 3 years down the road, 5 years down the road. But, saving and investing is always a great move to shore up your personal finances instead of spending more. So, seriously, huge round of applause for the American people who decided to give their credit cards a break and are pouring more money into their bank accounts and to their brokerage accounts. Good for them. I hope it works. I hope these end up being the correct profitable moves. But just from an asset allocation and a does this make sense kind of thing, I like to see it. We're cheering for you.
Yeah, I mean, I think you're seeing, Americans tend to be quite resilient and learn what's happening, right? I think you're just seeing the decline of the overall value that you're able to get, in everyday products, food, grocery, going out to eat, going to the movies. And so Americans are looking at it and saying, well, why wouldn't I take those dollars that I was spending on stuff that I'm getting really nothing out of at this point in time into something that's going to set me up
You know what,
for
Rob?
the future?
One thing that I would add to that, look, obviously, we are a channel about finance and investing. We are not a religious or spiritual organization here. But one thing I always like to see is there have been a lot of movements in recent years for people who have decided to live with fewer things. They're living a more simple, more Spartan lifestyle. And I actually think that's a great thing. And, one of the things I talk about is I travel months at a time, and I'm actually getting ready to leave the country for 11 months at a time. And, I live in a very comfortable, large house here in Connecticut. But when I travel, I'm often staying in much more sparse accommodations. I'm living with a whole lot less. I'm living out of one suitcase for months at a time. And the truth is, I'm not less happy. It's okay to have fewer things. It's okay to live a more Spartan lifestyle. And one of the best experiences I had was I was surfing in rural Nicaragua, and the place that I was supposed to stay at, it was supposed to be a nice resort. And I walked in, and, I think I've talked about this before. It was just a cement floor, brick walls, a light bulb hanging from the ceiling, and a, desk that looked like, a 15th century monk would be copying scrolls sitting at. But you know what? Like, I was there. I woke up early. I worked, I read, I wrote, I meditated, I swam in the ocean, I surfed, I got dinner, I went to bed early. I lived a
Yep.
very simple existence, and I enjoyed it.
Yep. Yeah, I definitely think there's something to be said for that. Gary, moving to thing number three. Before we do that, though, you're watching the non-transitory inflation issue of the five things from Deep Knowledge Investing. We keep you in tune with everything you need to know in the market and what's happening in the macro, micro, individual equities, the whole nine yards. If you'd like to sign up for our mailing list, head to our website, deepknowledgeinvesting.com. All it will take is first name and an email address, and you'll be notified of all future posting content material being distributed through the website. And then we also have our premium version of the subscription, $100 a month, and that'll get you access to all current DKI recommendations, Gary's buys, his sells, even more importantly, and a lot of premium access to guest speakers, webinars, and just a slew of additional information that is not gated. So would love if you would consider subscribing via the website. Gary, moving to thing number three, we're talking an OEM, Hyundai. They announced that they're going to have more manufacturing in the United States, up to 100,000 new jobs in the next 3 years. We've been seeing a lot of these announcements about foreign investment coming into the United States. Thing number three, Gary, Hyundai rides that wave of foreign investment into the United States.
Well, Rob, you're right. So it's $21 billion they're committing to. Um, and that is going to include a new $5.8 billion Louisiana steel plant. And so, a big part of this has to do with US trade policy, between the tariffs on imported automobiles and also tariffs on imported steel. Foreign companies are saying, you know what? We're going to manufacture in the US. And in the case of Hyundai, they're going to manufacture steel and automobiles here. So, that's your trade policy. Now, the anti-tariff crowd, the free the free trade crowd, they're understandably going to say, hey, wait a minute, isn't this going to end up with more expensive cars? And that could happen. And, President Trump actually addressed that, I think, within the last 24 hours. People said, hey, wait a minute, we're going to end up with higher priced cars. And he said, that's fine, whatever we need to do to bring manufacturing here. And so, there's a big debate going on that, but steel is a huge issue. You've got 25% tariffs on imported cars. And so, there is a sense of urgency for automakers to produce more here in the United States. At this point, we've seen announcements from Taiwan Semiconductor, the world's best semiconductor manufacturing company, for about $165 billion of investment. Apple, $500 billion. SoftBank, about $100 billion. Stargate, I don't know if they have the funding or not, but that's $500 billion. Saudi Arabia, $600 billion. Now, 21 billion from Hyundai. People can keep saying, oh, this doesn't count, this won't work, this isn't going to happen. Look, some of this stuff is going to take years, but at some point, all that's trillions of dollars of investing, that leads to more manufacturing jobs. And that's actually a national security issue here.
Gary, you mentioned it though. It is a complicated as well as controversial topic, right? In terms of these investments, what's included in them. I mean, what are people who may be against this saying? Do they have any good points? What do we need to consider from the other side of the argument?
So, Rob, I actually think both sides have good points. My issue is that there are very few people talking about this issue as a in total. So right now, the pro tariff crowd only wants to talk about potential new jobs. Now, is that a good point? Yeah, that is a great point. And what the US has been doing for about 40 or 50 years is outsourcing all of our manufacturing jobs. And basically what we've been doing over half a century is slowly selling off our industrial base and getting rid of those high quality, high paying jobs for people who, didn't spend six figures to go to college. Um, and there's only so long you can do that. There's only so long you can sell off the assets that prior generations built before you run out of things. We can't keep doing this. And the pro tariff crowd is saying, wait a minute, we have entire segments of the Midwest that are just dying from opioid abuse and don't have the opportunity for jobs we need to onshore. They're also correctly saying, wait, this is a national security issue. If you can't build if you can't build things, if you can't build cars, if you can't make semiconductors, you've got a huge problem. And I've talked a lot about the issues of not being able to manufacture our own pharmaceuticals. So I think they've got some great points. Now, let's talk about the great points on the other side, right? The anti tariff crowd wants to talk about potential higher costs. And that's true as well, right? Tariffs are a tax. And, when President Trump says, go ahead, so make, automotive prices higher, that is going to cost people more. Now, you know, is this working or not? I think the best explanation I saw of this is low tariffs and free trade, particularly where tariffs are low or non-existent in the US and our trading partners may have high tariffs. What that means is that we outsource jobs. And for wealthy people, we get low priced goods and low cost labor. And that's pretty good. But for the lower and middle classes, for blue collar workers, they get despair and no jobs. And so these policies, when they say that we're going to have more inflation and higher costs, that is a valid point. But when you look at these policies in total, they've been really good for wealthy people, really bad for the lower and middle class. And they don't want to acknowledge that. So, listen, I'm in favor of free trade, but I also see the personal downside and national security issues of outsourcing more and more manufacturing. Personally, I would rather see the country trying to encourage more manufacturing jobs than increasing social programs that encourage people to not work. So I think there are some advantages to what the Trump administration is trying to do. I think there are valid points on both sides. At a minimum, what I would like to see, if I could just get one change made, is I would like to see the people who are talking about this stuff in public do what we just did, which is acknowledge the good points of the other side, acknowledge that this is a complicated issue, and try to give people a full picture of this complicated issue rather than just talking points for their own side. And everybody claims that, they're the beneficiary, they're the protector of the lower classes of poor people, and the people on the other side are just evil people who want more money for rich people. Notice both sides are claiming that. Well, everybody can't both be, both sides can't be right on that. And the only way we get through this is, I think, a more honest, more complete conversation where we acknowledge the good points of the other side. In this segment, what we're trying to do is do our part to explain to people the good and bad side, the good and bad points of both sides of this argument. We're going to continue to do that.
Yeah, that's a great point, Gary. And I think one we take seriously is, hey, we want to have that discourse, that understanding. If you think we're wrong, why or because, right? Have that conversation and seeing things from both sides. So we encourage anybody, leave a comment, question that you might have for Gary as well. Be sure to follow up with those in any Good questions might even make their way on the show as we're having more conversations. As I'm sure this will not be the last time we're talking about tariffs over the next
It's
4 years.
Yeah, it's going to come up more often. And I want to highlight what Rob just said, which is, you may have strong feelings about this or strong opinions on it. Great. Just use the word because and explain, right? You're wrong because, or think this is the right way to view it because the people who just write, you're an idiot, I ignore them. They take up no time. The people who engage and explain their point of view, we respond to that. And so happy to have the engagement. Just explain why you think what you think.
100%. Gary, thing number four, we're talking AMD. Seems like everybody, or at least it's not a bad thing in the sense of trying to keep up with Nvidia can
There you
be
go.
exhausting. We've been talking about skepticism around lack of AI data center demand, which we'll touch on in this thing. But Gary, thing number four, AMD's outlook falls short. What do we need to know about AMD?
So, Rob, last week, Jeffries downgraded AMD. Now, normally I ignore the sell side. I don't find them to be particularly useful. However, this Jeffries report, I think, made some really important points. They cited weak GPU performance relative to Nvidia. Okay, that's a fair point. Now, in fairness, if you're a gamer, you might be saying, wait a minute, I get 500 FPS on my favorite video games using a less expensive AMD GPU. Fair enough, but the GPUs that Jeffries was referring to are not the ones used for computer games. They're really talking about the ones to train AI models. And in that area, NVIDIA remains the market leader. It is going to be very difficult to unseat them. There's also more competition coming from Intel. So, there we go. They also cited potentially declining AI data center demand. That's something we've been talking about here. And disappointment from AMD's outlook on its data center business highlights the widening gap between them and NVIDIA. They've got declining data center revenue. And because of that, they're facing lower share prices and more investor doubt. So that, I think that's what the key point is. And they gave guidance recently, and their projected guidance was for a down quarter on data center revenues. So, they're flat out saying we're looking at down revenue, not a slower rate of growth, but down revenue. And that's why the stock is down.
Yeah, I mean, Gary, anything else to point out in terms of why you think the stock is going down and in that direction? And then how much of this has to do with also, DeepSeek and what they've really done to disrupt this market?
Well, I think we should separate out the two issues that Jeffries raised. I agree with them on the GPU performance versus NVIDIA. The fact is AMD is still a powerhouse in CPUs for servers and gaming computers. They've done unbelievable work and grabbed huge share there. But right now the market is punishing the company for the gap between them and NVIDIA. And that persists. And again, it's because of not only NVIDIA's performance, but the way these models are designed. Everything is optimized for NVIDIA right now. And so it's going to be really difficult to unseat them. And AMD is struggling doing that. I think Jeffries is right on that. I'm not at all convinced that DeepSeek is going to lead to a lack of AI data center growth, or that growth is about to decline. We've covered this in the five things multiple times this year. I think the story that DeepSeek is going to destroy the AI hardware business is overstated and misunderstood. For one, I don't think DeepSeek did what they say they did. I think they had access to better chips than they claimed. I think they spent more than they claimed they did. Beyond that, there's no free lunch. There are no shortcuts. The thing that happens with DeepSeek's models is they partially train those models. They say, what are the questions people are most likely to ask? Let's research those. And they don't do the follow-on work. And as a result, and that's okay, I'm not saying that's a bad model, but as a result, training the model is much faster, much cheaper, requires a whole lot less infrastructure. And that's what people are focused on. The part that people are missing is that when you train a model in the way that DeepSeek does, every time there's a subsequent inquiry. So when you use the model, it's going to be slower, use more energy and more GPU resources to finish the research. And so basically, it's a matter of, do you want to do your work up front and then have very little to do ongoing? Or do you want to do a quick and dirty up front? And every time people make an inquiry, you're going to use a lot more in resources. So that's the choice that DeepSeek made. And when people are saying, oh, it doesn't use as much infrastructure as a result, the AI hardware business is going to be crushed. No, it means they're choosing to put the expensive work on the back end. Now, again, I'm not criticizing DeepSeek. I'm just saying people are misinterpreting it.
Great stuff there, Gary. And again, we'll keep in tune with everything happening AI. Obviously, moving very quickly. Lots of players in the space and how they're going to navigate and position themselves moving forward. This is the 5 things to know in investing this week from Deep Knowledge Investing, the non-transitory inflation issue. Again, be sure to head to deepknowledgeinvesting.com where you can sign up for a free subscription and be notified of upcoming 5 things distribution via email, as well as other content material being published on the DKI website from Gary, board of advisors, company updates, stock positions, etc. And we also have an Ask Gary feature on the website. If you have any questions about anything we're discussing on the show, or you'd like just additional information, or maybe dive a little bit deeper on a particular topic, please use that. Send in your question, and you may see that question show up on the show at some point in time. Moving forward to our 5th thing, we like to cover educational topics about investing. Today, we're going to be talking about automatic dividend reinvestment plans, DRIP, DRIP for short as an acronym. Gary, what I want to start with is we're going to talk about the pros and cons of these dividend reinvestment plans. But why don't you first tell us, what is a dividend reinvestment plans? What should our listeners know when they hear DRIP?
All right. Well, first of all, that is one of the worst acronyms in finance. Whoever came up with that is horrible. But yeah, it's the dividend reinvestment
Not us,
plan.
not I.
Yeah, we this one is not on us. We've come up with plenty of dumb titles, but this one is not ours. Let's start with the basics. Let's talk about what a dividend is. It is a return of capital from a company to shareholders. So, if a company were to make, I'm making this up, a dollar per share in a year, they might say, okay, we're going to take 20 cents of that and send it to shareholders as a dividend. Now, I'm making up those numbers, but that's how this can work. Now, do dividends matter? They absolutely do. And in fact, multiple companies that we own in the deep knowledge investing portfolio are very high dividend paying companies. We bought shares in multiple publicly traded limited partnerships that had, at the time we bought them, an 8% dividend yield. And this is at a time when the 10-year treasury was yielding maybe 3%. So that is enormous, right? Where supposedly risk-free US treasuries were yielding 3%, 4%. We were getting more than double that with capital appreciation. So we were crushing, our income on this was crushing what you get in US treasuries. And that's why this matters. So typically, if you buy stock in a company that pays a dividend, when that dividend is paid, they just put the cash in your brokerage account. And that's terrific, right? You have this current yield and your cash balance goes up. Here's what happens with a dividend reinvestment plan. Let's say, Rob, for example, you own stock in a company that pays a dividend and you enroll in the dividend reinvestment plan. And let's say the dividends on your particular investment are $1,000. So without the dividend reinvestment plan, they would add $1,000 in cash to your brokerage account. And then you could spend that or buy other stocks or do whatever you wanted with it. With a dividend reinvestment plan, on the day that that dividend is due, instead of paying you the $1,000, they buy you $1,000 worth of that company stock. So basically, you're saying, you know what? I appreciate the dividend, but instead of sending me the cash, right, put that, let that go into owning more shares. I just want to reinvest this, right? Don't send me the cash. I want to reinvest it and own more of the company that Actually, technically you own the same amount. You'd own more shares, right? But instead of them sending you the money, you own more shares. And that's the how to think about it and separate that.
Gary, what would you say benefits of these dividend reinvestment plans? If this is something in which you're invested in stock, dividends are being distributed, what would be the benefit for investors?
I think the biggest one is compounding returns, right? So, dividends can grow over time. And, one of the things that is really interesting when you look at companies that have paid dividends across decades, people who own those stocks over decades will often be in a situation where their annual dividend from that company is greater than the total amount that they invested in the company decades earlier. Well, now think about what would happen if they were reinvesting those dividends, right? You could get compound returns. And where the newly purchased shares begin to pay more dividends themselves. Remember, if you're buying shares in a company that's paying dividends, right, you would then get the next year, you would get the dividends on your original shares and the newly purchased shares. There are some other benefits as well. Sometimes DRIPs, I can't believe I'm using that acronym, they may offer share discounts or reduced investment fees, and that would give the investor a small bump in returns. Does that matter? Not in any particular year, but again, if you're doing this across decades, these things do add up. Finally, DRIPs don't require any management and they allow investors to continue to invest without the stress of deciding how to allocate newly arrived capital. It basically forces you to keep investing in the companies that you like, as opposed to having cash that you need to figure out what to do with. Now, for me, as somebody who's managed money professionally for decades, I like having cash in my account because I'm always looking for new opportunities. If you're working a full-time job and taking care of a family and a home, you may have other stuff going on. Like I don't have other stuff going on. This is my focus all day, right? You may have other stuff going on and may not want to think about, okay, now what do I do with this?
Yeah, great point, Gary. And I know personally, yeah, that's kind of the boat I fall into as well, right? Is that ability to just reinvest for all the benefits you mentioned. Let's
Yeah, but
shift
the difference
gears
is I
though.
take your calls.
That is true. Well, hey, there's a premium subscription for everything, right? You just got to host a weekly show for an hour or two, and then Gary, you can pick up the phone and call Gary.
There you go. If you want to
Gary, drawbacks.
replace Rob, IR at
No, 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 no,
deepknowledgeinvesting.com.
no. Then he won't answer my calls, so then I'll be really in trouble. Then I'll have no value. Gary talked about the benefits. Now, flip side of that, right? You maybe highlighted a little bit, probably some control, flexibility, right? But what are maybe some of the drawbacks of drips or just things to be aware of?
So there are a couple of things. One is you may have a lack of liquidity and control when it comes to using these investment plans, right? Remember that if you buy stock in a company, you're buying stock in a company, you choose your entry point, you choose your exit point. Um, by reinvesting your dividends, you do not control when you're buying shares. It will be done for you on a particular day at the price that the stock is that day. Um, Also, it's important to note that dividend reinvestments are taxable by the IRS and they're treated as if they would be collected in cash. I'm just going to highlight we are not tax advisors. Deep Knowledge Investing is not a tax advisor. We are not giving tax advice. If you have questions on this, check with your tax professional regarding your personal circumstances. But the thing to point out is depending on your circumstances, you could be in a situation where you reinvest that money and then you owe cash taxes on it. And, there's no guarantee that the stock that you reinvest in will go up over that time period. So you could have a situation where the money is reinvested, the stock goes down maybe temporarily, but you might have to sell some of it to pay a tax bill. So you need to plan for that. It's also worth noting that drips are specific to one company only. And so it makes sense if you want to invest more to a particular company, but you may want more diversification or to disperse those dividends across multiple investments. It's really a matter of how much liquidity and control and diversification you want. And drips, while great in many ways, will give you less of that diversity, less of that control, portfolio diversity. I'm talking about, not personal. Um, and then you just have less control over that. And so that's the downside to it. And that's the thing to keep in mind.
Gary, just to wrap up this educational topic, Let's focus on the beginning investor for this last one. But what's kind of for you, speaking to a beginning investor, what's really the key takeaway? What do they need to know about dividend reinvestment plans when considering their options?
So I like that you're delineating here. Like, I don't personally use dividend reinvestment plans because I'm always looking at allocating capital. Again, this is what I do all day, every day. For a beginning investor, um, it might be tempting to take cash dividends and not reinvest, but just a reminder, the best time to begin investing is at a younger age. The next best time is now. And so dividend reinvestment plans offer people, beginning investors, an easy, low cost way to reinvest dividends for long term growth. Compounding for a longer time can result in larger dividend payments down the road that, you may decide to collect those in cash when you reach an older age and you use that account to fund a retiree lifestyle. But, you know, if you are a younger person, this is a great way to force yourself to not take dividends and spend them, but to keep investing. And this is something we were talking about earlier in this version of the five things. We were applauding more Americans for saving more and investing more and spending a little bit less, or rather increasing their spending at a slower rate. This is a great way to be doing that. Rob, I really should have renamed this episode the, consumer responsibility episode, or the investor responsibility episode. And it's great to see all of you guys doing a much better job. The last thought I have on this topic, regarding the dividend reinvestment plan, and I do think it's a good thing for beginning investors. But if you wouldn't buy the stock at current prices, you might consider whether you want to own it at all. Right. So if you use the dividend reinvestment plan and you're saying, wait a minute, I wouldn't pay today's price, then you own too much of it in your account and maybe you need to reallocate to something that's less expensive. So, you know, a lot of times people like to look at their historical cost. Professional investors will tell you, do not do that. Your historical cost doesn't matter. You own your portfolio every day at the current price. So if you wouldn't buy it, you might want to sell it.
Yeah, I think that's great advice and a great way to wrap up this week's version of the five things, Gary. And hey, someone's got to be responsible at some point, right? We've been talking about all this irresponsibility over the past 3 years. So cheers to the consumers, to the retail investors. Great stuff that we're seeing. And again, if you have any questions, please leave a comment, head to the website, use the Ask Gary feature. We'll be glad to circle back on some of those questions that we receive. This wraps up this week's version of the five things to know in investing, the non-transitory inflation issue. As always, thank you so much for tuning in and watching Gary and I speak, or Gary speak heavily, me ask some somewhat decent questions about what's happening in the market. We're really excited for next week's version. Again, head to our website, sign up for a free newsletter subscription, add your email to that list to make sure you don't miss anything that's coming up in the pipeline. We'll make sure you have everything you need to know when it comes to what's happening in the market on a week by week basis, as well as keeping track of trends as time goes on, obviously. Gary, turn it over to you for the closing thoughts for this week's five things.
A couple people that we want to recognize. One is, again, the American consumer. Those of you who have decided to spend a little bit less and save and invest more, terrific. Good for you. We are thrilled and hope it all works out. We're all in the same boat on that one. For those of you who want to invest more but are worried about the levels of markets or a declining market, one of the things that Deep Knowledge Investing does is we help our people hedge. And so, while the market has been going down in recent weeks, our hedges have outperformed. And as a result, many of us are not losing money, or certainly a lot less than the market is. We can help with that if that's something that's of interest to you. Beyond that, round of applause for Nazim the Dream, and Anton, who are doing a phenomenal job coming from Flying V, helping us improve the way we're presenting videos here on YouTube. Those of you who are longtime viewers will see the quality of the videos is getting better. They're working on different thumbnails. It's fascinating to watch them work. I'm really just enjoying watching the conversation back and forth. Great to see it. Rob, I always appreciate you doing the show with me, taking time out. That is fantastic. I also want to talk about our interns for a second. Josh Reeves from the University of Tennessee has moved on. He does so with our applause and appreciation. A lot of times people get upset when interns leave, when they move on. My view is the number one reason, if you're a young person, to do an internship is to open doors and better opportunities down the road. Josh got a phenomenal opportunity. If I were in his shoes, I would have taken it too. And when that happens, look, it's always hard to lose somebody as talented and smart and effective as Josh has been. But, if the reason for it is they get a terrific opportunity, that tells me that at Deep Knowledge Investing, we are fulfilling our responsibility to the young people who help us produce this content. We celebrate the successes of our interns. And while it's hard to lose Josh, round of applause for all he's done. And, round of applause for all the former DKI interns who have gone on to bigger and better things. Again, that means we've fulfilled our responsibilities to them. Cash and Crow, our new intern from the University of Tennessee, has stepped up and in just a short amount of time has become incredibly effective. He was a massive contributor to this week's work. Coming up with topics, writing, researching, coming up with images. Cashin has been phenomenal to see your progress in recent weeks. And finally, for those of you watching this, we know your time is valuable. Thank you so much for taking the time to spend it with us. We appreciate it. We appreciate you. And we'll be back in a week with the next version of the 5 things. Thank you.
Thanks, everyone.